Stock price movement could, to a large extent, be driven by emotions rather than company-specific fundamentals. You know, emotions like fear, like greed, like pessimism, like optimism, like euphoria. Just name them. All these emotions can have a tremendous impact on them, on the markets, and how stock prices behave in the market. So in this we don't talk about how fear and greed drives stock market trends. How fear and greed drives or influence or impact stock market trends. So fear and greed are powerful emotions that heavily influence stock market trends. Extreme fear has its impact, and extreme greed also has its impact. So here is how they shape investor behavior. First of all, they will shape investors' behavior, and that will equally, determine the kind of sentiments, that investors will generate, which will translate into how stocks behave in the markets based on the activities of market participants. So there's that fear of loss, what is called panic selling. But one is fear of loss. Fear, often lead to panic selling, especially during market downturns. We don't want to lose our money. We don't want to lose our money. People just start, disposing their position. So investors who, fear further losses may sell off their holdings, causing stock price to drop further. When you have massive sales, sell. You go to a typical buy and sell column, you discover that you have, plenty sellers and few buyers. So in that case, that's could be panic selling, and the price will plummet further because the market acts or function on the principle of demand and supply. When you have more supply of shares, people are selling, and a lesser level of demand is what the price will then keep on dropping further. This behavior can create a market correction or crash, as fear spread rapidly among investors. So it has that potential of creating a correction, which is a good thing. When stocks are overvalued or overpriced, then correction sets in to bring stocks back to normal level that reflects fundamentals. But if it leads to market crash, that's something negative actually. So it could lead to fear. It could lead to correction or crash. So fear is very powerful. Fear of loss could drive investors into panic selling. Number two is greed for gains. Overbuying can lead to overbuying. Greed for gains. Someone said greed is good. I don't know. I can't tell. So that greed for gains. And so greed drives investors into to seek higher returns, often leading to overbuying during bull markets. That's it. So greed will lead to overbuying. Normal expectation, normal desire of making a profit, of making a decent return is just normal. That one will not lead to an overbought situation. It will not lead to overbuying. When greed sets in, that's something beyond normal. Then of course it's not a very good thing at all. So investors may push stock price to unsustainable levels, inflating market bubbles. The price will continue to grow to a level that may no longer correlate with the company fundamentals. So greed can cause investors to ignore risk, focusing only on potential profits, which can lead to market instability. When reality sets, the reality will always set in. A particular stage or state cannot continue forever. Panic selling cannot continue forever, and overbuying out of greed cannot continue forever. The market will eventually, do what is right. Please subscribe to this channel and like this video. so as to encourage me to keep on, bringing to your satisfaction videos of this nature. I want to make you a better investor so you can be financially independent in the long run. Number 3 is the market cycles. How how do fear and greed determine market cycles? Number 1 is bull markets. In a bull market, greed tends to dominate. During periods of optimism, greed dominates, and as stock prices rise as investors compete to buy, this can create an overvalued market. When you have participants, keying in buy orders, buy, it can lead to an overvalued state. So it creates a bull market. Then the other one is bear market, when fear sets in. So in contrast, fear takes over during downturns, causing widespread selling and driving prices lower than their true value. The entire thing is always extreme. It leads to extreme conditions. Whenever there's greed, it drives the markets above normal, ceiling. When greed sets in, it drags the market below, normal trough, above normal peak for greed and below normal trough or bottom, when fear sets in. Number 4 is hard behavior. So both fear and greed often leads to hard behavior, where investors follow the crowd. Whether the crowd is right or not, people don't really bother. They just follow the crowd, feeling that expecting that the crowd could be, will be right. Sometimes, most times they are, but sometimes they are not. So in bull markets, this can amplify price increases, while in the bear market, it can accelerate the decline. In the bull market, hard behavior will cause price to keep on climbing, and in a bear market, the same hard behavior will make prices to go down lower than even lower than necessary, or lower than what the fundamentals suggest. Number 5 is contrarian indicators. Contrarian indicators. So in this case, you have extreme fear, like during a typical market crash, or excessive greed, like in the bubble. All right, the .com bubble and bust. So this can signal, potential market reversals. Usually, extreme fear will lead to a crash, and that will be followed by extreme greed that could lead to a bubble. So contrarian investors often take advantage of these periods by buying during fear and selling during greed. Someone say buy when there's blood in the streets. When there's extreme fear, people are panic selling, very good companies at a giveaway, undervalued prices. So that's the right time for you to buy if you have sufficient cash. You buy good, wonderful companies at a discount. So in essence, fear and greed create volatility and can lead to market bubbles and crashes, making it important for investors to manage their emotions and make decisions based on fundamentals rather than market sentiments. Let fundamentals guide your investment behavior. Forget about sentiments are not long lasting. They simply come and go. But the impact of the fundamentals will last a long time.